we got to talk about Mr. Greg Davis. He's thinking that their Federal Reserve may hike not one more time, Anna, but two more times.
I've been really tracking what's happened over the last couple of weeks. It is showing that the economy is again stronger than what the Fed thought. Treasury rates are going up higher. And guess what? We are spending almost $9 billion a day in the US.
Alrighty, folks, we got to talk about Mr. Greg Davis. Who is Greg Davis? He is Vanguard's Chief Investment Officer, aka CIO. The reason we're going to talk about Mr. Greg Davis with the one and only Anna Kelly is Greg Davis is he's thinking that their Federal Reserve may hike not one more time, Anna, but two more times. And I just thought I would get your instant reactions to the potential for two more rate hikes, not one. What do you think?
So first, I will say I have not read his article or his commentary, so I don't know what his arguments are. But I will say I've been really tracking what's happened over the last couple of weeks. And again, the data's all over the place, but it is showing that the economy is again stronger than what the Fed thought. Treasury rates are going up higher. And guess what? We are spending almost $9 billion a day in the US government on the fiscal side and expect to do the same for at least 90 more days. So when you have treasury yields going up and the market's going, I'm out unless I get paid higher rates, and you
Right.
have higher fiscal spending and you have a strengthening economy, fiscal spending increases GDP, at least to some extent. And
Mhm.
so all of these things and us getting involved in not one but two wars at this point, all of those things, increased spending, equates to higher inflation, equates to the Fed needing to do more in monetary policy to get that inflation down. Do I see one or two? I don't know how many. I do see more rate hikes unless we
Really?
have a deep recession, just because of where all of that is leading, which is inflationary, unfortunately. So unless something breaks, or we have a deep recession, which keeps kind of being pushed off, I don't see us holding for long, although I do see us potentially holding for November.
Yeah. So you do see a pause, which actually comes out in 4 or 5 hours. We're recording this,
Yeah.
folks, 8 a.m. Wednesday morning. It comes out at 11, I think. So 3 hours from now. So you do see a pause for this month, but I'm guessing you see a December hike is, I'll call it likely.
I do. I do.
Okay.
I wouldn't have said that a month ago. Um, but again, the data just continues to get more inflationary from multiple different fronts. And I think that that's really kind of tying the hands of the Fed to go, we thought we were making progress, but all of the other things we're doing are being offset by fiscal policy. And that's something called fiscal dominance, which we haven't talked a lot about on this show. And I don't hear very many people talking about it, but we're so concerned with rates, and what's the Fed's rate
Yeah.
going to be.
Yeah.
But there is just as much impact on where rates go based on, currencies in other
Mhm.
countries, the strength of the dollar, fiscal spending. And fiscal dominance means the fiscal side, the Congress is spending so much money, which is inflationary, that it dominates the ability for the Fed to use rates alone to get
Oh,
inflation
yeah.
down. And I think that that's what we're seeing, unfortunately, Michael.
No, I couldn't agree more. Stanley Druckenmiller is out pretty aggressively in the last 48 hours or so, certainly the last 24, pointing the finger at Treasury for not extending the duration when we had rates at 1 or 2%. Now rates
Right.
are higher. We're spending more and more of our funds on just interest payments. And
Yes.
something we talked about, I think it was 6 months ago. Jerome Powell is trying to put his foot on the brake of the economy, but Congress is not helping him. Right there,
Right.
Congress is freaking, adding nitrous oxide, full gas, no brake. And Powell's like, guys, what are you doing? Help me out here. And
Absolutely.
yeah, I think something we'll try to add in as a fourth conversation. I'll tease it here. But Stanley Druckenmiller this morning on CNBC, at least that's when I heard it, basically said it's time to seriously look at cutting entitlements. And he specifically went after Social Security. And,
Right.
no politician is going to say that. But we are quickly running into a situation where we can't pay everybody. And Stanley
Right.
Druckenmiller is saying, hey, cut some entitlements.
I agree. And if you really study what happens when economies have big debt cycles, like they have insurmountable amount of debt and inflation, which leads to higher interest rates, what are their options? And the only real options are one of three, at least historically, unless somebody comes up with something new or a new system, right? And wipes all the debt away and pretends it's not there, which isn't going to happen. There's basically three options for a government. It's cut entitlements, expenses, basically austerity, cut everything back to bare bones. No politician's going to do that with an election cycle coming up. They don't, because it's basically helping the future of our country and the economy, but it's political suicide. The second option is raise taxes. Well, guess what? Same problem. No politician's going to say, let's raise taxes while the American people are hurting, while there's high inflation. It's political suicide. So what is the other option? They devalue their currency, aka spend more money to create inflation. That causes interest rates to have to go up to counter that inflation. And so again, unfortunately, I don't see us cutting spending or raising taxes anytime soon, even though I would be for both of those things. So the only option is keep extending, kicking the can down the road, printing money, and devaluing our dollar without the people really noticing it. And all of that, unfortunately, leads to higher interest rates longer term than what we hoped for. So what was the argument of the CIO this morning?
Yeah, Greg
Because I
Davis
didn't
is
read it.
basically he is saying, look at GDP, 4.9% was just printed. A well-balanced GDP. It wasn't dominated by one sector, right? It wasn't all government, for example. He's also talking about the job market being remarkably strong. We also have structural things going on with our, our workers, right? So wage inflation looks very likely to be sticky and to continue moving forward. And obviously, we have a lot of debt. So he's like, hey, we're going to have to pay up. Basically, we're going to have to pay up to get people to buy our treasuries. That's in a nutshell.
Right. And I think that people in the real estate world underestimate what the treasury rate does to our interest rates. It trickles down. And
Oh,
so
yeah.
it's not just the Fed can say I'm raising or lowering, and then all of a sudden the interest rates, drop. Most of the pressure on rates really come from the treasury market, because the 10-year treasury is really the benchmark for any other interest rate. 30-year, when you're talking about residential, homeowner mortgages for 30 years. But the treasury rate and what the treasury has to pay as the carrot to get people to continue to buy treasuries, even though we're basically a bankrupt company. We have more liabilities than we do assets. That has a substantial impact. And so if Congress doesn't get the fiscal side right, and they're going to have to pay higher to do that, monetary policy becomes much less effective than what it has in the past, unfortunately. And so, I don't know where things are going. I could make the argument that we're heading to a deflationary economy in many, many other sectors and areas, which should cause a recession and should cause, rates to come down. But there's all these other pressures that make it so complicated today. For every headwind, you have a tailwind. And so I just expect that it's going to be bumpy for a few years till we get ourselves out of this mess, certainly past the election cycle. So I don't really see much reprieve for 2024, unfortunately, unless something really breaks in the financial system. And it still could, banking system, et cetera. So again, I don't think we can make decisions with the hopium that rates come down. I think we have to make decisions on what do good deals look like today. If rates were to stay the same, or if they were to go up, would I make the same buying decision today? And I think that's how we have to look at these things, Michael, is we can't really predict with any accuracy, although we've tried, based on history, to say, in 6 months, here's what rates are going to be. In a year, here's where rates are going to be. We have to go, what's the big picture? Is it looking like where we are now or higher potentially? Yes. And so only do deals if they cash flow today. If you need cash flow, don't say, "Oh, I'm going to buy it now. I'm going to be negative cash flow, but in a year rates are going to be down and I'll refi."
Yeah.
I hear realtors making that argument, but as an investor, you don't want to do that. So do a good deal that makes sense for you today, lock in long-term debt, and then as things shake out, if rates fall, refi and buy more. If rates don't fall, then you've locked in your rates and you've kind of hedged your bets.
Yeah, I couldn't agree more. We're going to talk about higher for longer in the next video because Kevin O'Leary is talking about 3 years of pain. But before we get to that, Anna, where can people find you?
Thank you. You can find me here on your show and my playlist on your channel. You can find me at social media at Anna Kelly REI Mom. And you can find me at my new website, AnnaKellyInvesting.com, for coaching and consulting.
That is awesome. Thank you so much.